Paramount Global stock has fallen to 16% or down 30% in a single day. This is a behemoth of the entertainment industry, and if this stock recovers, you can make 5 times your money. I'm going to show you how. We're going to walk through the assumptions. You can tell me if you like it or not. Ready? Let's get to work. Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel, all the comments and subscribers. I greatly appreciate it. We're going to go through Paramount Global, or Para as their ticker's called. They own brands like Paramount, Showtime, CBS, Nickelodeon, MTV, BET, and they have a subscription product called Paramount Plus. It was a merger between Paramount and Viacom many years ago. Now they're transitioning into a digital world as the subscriber growth for the Para Plus is growing at 30% annually. But the margins are down in this business, and the stock has been hammered recently as they're adjusting their growth forecast out in the forward periods. So let's figure out how much we think this stock is worth based on a conservative forecast and looking out 10 years. Now, I want to encourage you to read your 10Ks. We're going to go through the annual 10K, which is the annual report. We're going to look at Q1 earnings release just to have a couple tidbits of where 2023 is shaping up, but I want to highly encourage you to read all of the disclosed information that every investment you make releases to the public. And I'm going to show you my assumptions. Learn how to make the assumptions, make your own assumptions, and do your own due diligence. Now, we're going to review this stock with the 5 key attributes like we do everything on this channel. We look for 5 key factors. Number 1, top line revenue growth. Number 2, earnings growth. We use EBITDA earnings. Number 3, strong free cash flow. Number 4, low debt. And number 5, a well-priced stock. What is a well-priced stock? A well-priced stock is a stock with a conservative growth forecast that over time will outperform the market, or at least based on some conservative assumptions would outperform the market. So we're going to review Paramount on this framework and kind of dive into the P&L a little bit and understand what this business is doing and how much actual cash money does this company make, and is it worth the price, or $16 a share a bargain? Ready? Let's do this. So the first thing I want to do is just really quickly review Q1 2023 results. It's the most recent results we have. This channel is dedicated to the long-term rational investor, so we don't generally bet on one quarter or the next. It's impossible to tell what's going to happen. We want to look out 10 years or so, but we can still judge what 2023 is shaping up to be. So you can see Paramount Plus reached new milestone, 60 million subscribers, adding 4 million subscribers in the quarter. Now, last year, this 60 number was 65 was their target. So they actually missed their target for 2022 fiscal year by about 10%. This is Q1 2023. They hit 60. This number was 65 as their target ending last year. So they're a little underperforming, but it's still growing. 65% year over year is nothing to sneeze at. So this is the one segment that is growing. They have other segments. They call this one the direct-to-consumer segment. They have the entertainment segment, and then they have the TV and media. And the TV and media is the behemoth. It's growing at maybe less than 1% a year. This year, I think this quarter, it actually came down slightly, but it's basically 80% of their revenue is this TV segment. And you can see it right here. It's basically CBS broadcasting, Paramount cable network, and the business declined revenue 8% year over year. So that is hammering the stock as their traditional media, which is the lion's share of their revenue, declined last year. Historically, it's grown about 1% or so a year, but I think that recent news here is what's caused the stock to decline. Let's take a look at the 10K and look at the operating margins. Let's walk through their 10K for 2023. Their top line revenue has been growing $25 billion, $29 billion to $30 billion. So top line's growing on the back of the Paramount Plus digital offering. What's interesting here is the operating costs are growing faster than revenue. $20 billion, $25 billion, and $28 billion, which produced an operating income of only $2.3 billion in 2020. That's down from about $4 billion or so a couple years ago. And that's mainly because their operating costs are growing too quickly. And they're going to have to tackle that in the forward to bring back margins on this business. As I think the production costs, inflation is biting into this business, and they're going to have to figure out how to synergize to bring back margins to where they have been historically. So I think this business has two main factors. One, the segmentation of revenue. So if you go through their 10Ks, you're going to be able to pull together the segmented reported revenue. So as I said before, TV and media Direct to consumer, that's the Paramount Plus, and then the entertainment section, which is basically the big movie launches and other. There's some other revenue sources to give you total revenue. TV and media here at $22 billion grew and then shrank to $22.1 billion. Next year, we've got slight $22 billion forecast for that segment. The direct-to-consumer business is the one that's growing fast. $1.8 billion, $3.3 billion, $5 billion. I've got 5.2 here as the forecast for going forward. And the entertainment section is all over the place depending upon the big movie releases and so forth. So you get your total revenue. That's component number one. The next component is the margin in this business. As you can see, the business was 20% margin, 15 and 11% EBITDA margin over time. We're expecting that to continue to come down. If we look at 2023 Q1 results, their margins are low and they need to fix their operating costs. They need to cut costs. They need to figure out how to run these segments more efficiently, how to make content a little bit cheaper or raise the price, one of the two. So what we're doing is we're saying, hey, it's 5% EBITDA margin, and they'll slowly recover to about 15, 16% EBITDA out 10 years from now. They will also be able to grow TV media from the $22 billion to about $25 billion out 10 years from now. You get $7.5 billion of the DirecTV business, the direct-to-consumer business, and basically maintain 3.5 of the entertainment, the big movie blockbuster releases. That takes revenue and grows at about 20% over this 10-year period of time to $36 billion at a 16% EBITDA margin. Means I'm targeting someplace close to $5.8 billion of EBITDA out 10 years from now. They're currently around 3.2. All right, now let's review the historical numbers for this business and we'll build a forecast. So behind me, I've got the revenue from Paramount and Viacom as they merged a while. I had to take the two P&Ls, merge them, and then when they started reporting as one company more recently, I kind of switched to that. So it's a little chunky. But basically, you've got $14 billion in 2023. Grew, you got the merger here of $26 billion as they combine, and you've got a slight growth here, 26 to 30 billion over time. This 9% CAGR is really just picking up the entire history, not really relevant. So you're looking 26 to 30 billion over the last, say, 5 years, not too bad. EBITDA over this time has been profitable every year. It's come down, I think, as they've maybe leaned into the digital offering, much like a Netflix or others digital offering that ends up spending so much on content that they run at a loss, which is what Paramount Plus is currently doing. They need to figure out how to run profitable. Hopefully that profitability grows as they scale, but that's definitely something that they need to do. It has grown historically. I think recently it's zeroed, and we're hoping that as this grows, the margin will come back. Debt levels $18 billion. $18 billion on $3 billion worth of earnings is a problem. We'll get there in a second. Excess cash, the drop in earnings last year, I think has removed a lot of the excess cash for them. And as a result, the market cap has fallen. It's continued to fall. It's now $11 billion as of the last fiscal year ending December. So when we look out in the future, we can look at debt ratios. They were basically 3 times, a little less than 3 times historically. After the merger of the two, it's gone up above 3, kind of slightly above 3, which is not where we want to be. We were giving it a pass because it was roughly 3.2, last year. But with the drop in earnings and debt maintained, the ratio has spiked. They're now at 5.8 times, which is too high. It's above our 3 times debt to EBITDA leverage ratio, and they need to fix margins to pay this down or boost earnings to right size this number, basically get earnings back to what they once were. And that's the direction I think they're going to go. I think they'll have to cut costs, they'll have to consolidate departments, they'll have to figure out how to make more with less. Enterprise value EBITDA is kind of bottoming now as the stock, this is as of December, the ratio going forward is probably even worse. But it's 9 times EBITDA. It's probably a little less now that you're trading off a $16 share. This price is $16 too. So this is right. We're hovering around 30 billion of enterprise value on a trailing EBITDA of a low number, right? 3.2 billion. If they were able to get this back to 5, though, then the forward multiple here is pretty cheap at 6 times. Let's take a look at free cash flow. Okay, adjusted free cash flow for this business was decent, about averaging 1.3, 1.6 billion, almost to $2 billion last couple of years. In 2022, it was a terrible year, minus $300 million as operating margins shrank. Then free cash flow disappeared. So they went from generating cash positive almost every single year to margin compression, and then some taxes they had to pay, and that turned them negative. CapEx maintained. They have to maintain spending that cash to continue the flywheel. So that money goes out regardless if you're cash flow positive or not. And that's why I took down the excess cash on the balance sheet, because if they're losing money, if they're burning cash, that's no longer excess. That's now cash they absolutely need to maintain the business. Debt, they paid down debt, paid $2 billion down. I think this is them acknowledging that their debt ratio was going to be high as earnings dropped, and they're buying down debt, which is what I want them to do. Free cash flow goes negative because of operating margins are negative. You have CapEx and you're buying down debt, so that's depleting cash on hand. It can't be maintained forever, and I don't think anybody's expecting it to be maintained forever. So that's why the stock is still positive, right? Or still above zero, because you have to have a positive cash flowing business for it to have value. So this is clearly temporary. 650 million shares outstanding, bought a few shares, but I would expect this to be flat going forward. Cash flow per share, I don't think is meaningful right now because it's negative. The question is, what does it revert back to when margins are restored? We'll get to that in a second. And then you're currently at $16 a share, roughly there, which is really interesting price per share. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one, summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. Okay, let's forecast this business. So we know that they have a lot of assets that produce value. They've got a subscription program with 60 million people buying and paying subscriptions. We can put a forecast revenue on that by simply saying you've got subscribers, you've got an average price, and you get a forecast revenue. I think that's fairly easy to forecast. The question is, can they grow it? Can they take the 60, 70 million and grow it to about 100 million subscribers out 10 years from now? I think that's your risk. That's some question marks. And second, can the TV media division continue to grow given Q1's drop of 8% year over year in one quarter? I don't want to take that and just string that out going forward. We need to be rational about this. The TV media segment has been under pressure for a long time, but they've still been able to grow it. So we have basically 1% growth on that number out into the future. What that does is it produces an EBITDA for us of $1.5 billion out next year, which is a 50% cut from where it was before. And we're obviously not trying to value the business on today or even next year's earnings. We want to know 10 years from now, is Paramount Global going to be around? And then if it is, how much value does this business have at that time, and what would be a reasonable price to pay for it? So what we're basically saying here is I'm going to have $1.5 billion today, which is why the stock is down. Over time, I'm going to grow the subscriber base. I'll find some way to continue to monetize the TV media division for about 1% per year growth. And I've got the entertainment movie launch business, which is not going to grow at all and just kind of maintain it. Hopefully, this infrastructure can be maintained. And if it does that, and margins grow back to about 15% margin, then your $1.5 billion will grow rather quickly, despite the limited growth of revenue, to $5.7 billion. And when I do that and I put a 10 times market multiple on that, I get just shy of $60 billion of value, less the debt that they have now. I'm saying it's not going to grow. They're not adding debt. They're not buying down debt. They're just letting earnings recover, and that brings the debt ratio in line. They get a market cap of $39 billion divided by shares. I get a price target of $60.75 on an EBITDA market multiple method out 10 years from now for Paramount Global. Now, if I do the same thing for free cash flow, and I say, well, free cash flow next year, I think is about $1, putting even debt payment aside. I'm not assuming debt payment. Cash flow would be negative if they had to pay, if they continue paying down debt. But I'm saying if the strategy is to recover earnings, and their bank will allow them to have a coverage ratio of above 3, 5.8 to 1, then they have time to recover. If the bank says, no, I need you to pay that down now, then cash flows will be negative for a couple of years as they continue to pay down debt to bring leverage ratio back in line. But I think the most realistic option for these guys, and what I would do if I was the CFO of Paramount Global, is I would focus on cost cutting. That's the biggest bang for the dollar. It's going to be very hard for them to pay down debt to the scale to bring the market multiple, it's going to be the multiple down that quickly. That doesn't happen. Debt multiples take many, many years to buy down if you have to buy it down. If you can cut cost and boost earnings, that's the fastest way to fix the ratio, and I think that's what they're going to go. They'll attack the operating margin and figure out how to squeeze more out of that revenue. So they're at $1.04 per share, and as EBITDA recovers, assuming the same capex and some taxes they have to spend, that EBITDA will flow through to the shareholders, you and I, the common stock equity holders, and you'll go from $1 to just shy of $4 in cash flow out 10 years from now. And so if I apply a 6% yield to that, then I get a $65.40 price target out 10 years for Paramount Global. Now let's put this in IRR for us. So in context, if I get this stream of cash flow, which is by pro rata ownership, they're not going to buy down debt, but they're going to grow back earnings by cutting costs. I can buy the stock at $16 a share right now. I think between the two forecasts, you're in a $60 range for a stock out 10 years from now. When I do that math, this consolidated sweep of cash flow, and I use this IRR function in Excel, I get a 27% annual IRR, which means 27% compounded every single year over a decade. And when you do that, that math works out to 5.6 times your money out 10 years. I'll put that on a little distribution scale for you so you're here. If you're looking at this in the future and the stock is moving around, it's $16 right now. These assumptions produce a 27% annualized return. If the stock goes up, I think it's still interesting. It's still north of 20%, much, much higher than the S&P on average. If it comes down, I think it continues to be attractive, so long as the brand, the value is continued to be maintained. Let's review the 5 key attributes. Now this one's a little tricky, and it's going to be up to your judgment. You let me know what you think as well. Number 1, top line revenue growth. That is growing. Number 2, earnings are not growing. They're declining right now. We acknowledge that. We think long term they can, but I'm not going to check the box. Number 3, strong free cash flow. No, they need to pay down debt, and they either pay with cash flow or they cut earnings. We're assuming that they cut costs to boost earnings, but they could have to use cash to pay down debt. So I can't check the box. Number 4, low debt. No, it's 5.8 times leverage. And number 5, is it well priced? Yes, it's well priced. So I can check the revenue and the well priced box. The other ones don't get check marked for us if we're being strictly classical to the 5 key attributes, right? We want to check all 5 for further due diligence. What I think is interesting about this stock is it's very difficult to find companies with a growth forecast that produces something like 27% in the stock market. So this could mean that the stock is oversold at this point, but you have to come over the fact of a couple things. Earnings are going to be negative earnings are going to be down for next year. Cash flow is going to be strained as they get the debt, but could still be positive. If they don't have to pay down debt, cash flow should be positive. And they have that leverage ratio, which could go away if they're able to boost earnings. So you've got a couple things there that you need to risk adjust for yourself. And if you think that, hey, I like Paramount, I like MTV, I like the brands that they have, and you think out 10 years from now, those brands will still be around and powerful, which I think is fairly certain, then it's a matter of what kind of cash flow can they produce in that. If they've produced in the past $5 billion of earnings here, for several years running, and the forecast is saying, hey, all I need is another $5 billion, which is what they produced in 2020, 2019, 2018, 2017, all these years they made $5 billion of EBITDA. I'm saying they need 5.7. I'm giving them 10 years to do it in. I think that's pretty conservative. And so then if you say the brand's going to be around, they can get earnings back, which if they get earnings back, fixes cash flow, fixes debt leverage, and then I put a 10 times market multiple, I get a $60 stock price pretty easily, in my opinion, on a risk-adjusted basis. So what I'm trying to say is I think here this does not check the box, but is a very interesting investment opportunity if you like this type of risk-return profile. So what I'm going to do is technically, I'm going to give this a meh. Because I can't give it a good, it doesn't check all the boxes. I'm not going to give it a bad because I think there's a lot of fundamental value here that's interesting and temporarily disrupted because of what's going on in the market. So take a look at Para. Let me know what you think. Throw a comment down below. Let me know if you like this stock. If you want to see other stocks that in this format. Also check out my website, cashflowinvestingpro.com. There's two things there. There's an investing course that I teach where I give you an Excel sheet like this. We walk through Apple and I show you how to calculate revenue, EBITDA, debt, how to make a forecast for a business, what is free cash flow, what are market multiples, what are cash flow yield, how to adjust for stock splits or reverse splits, some basic financial and investment, not even investment, but financial fundamentals that you'd get in like a Finance 101 course. I laid out to you in about 3 hours of content, and in there, you're able to hopefully make models like this for all of your investments and track your investments a bit better than just watching a ticker on the screen or listening to some guy on YouTube prattle on. Also, if you like this but don't want to do the work, you can look at the Cash Flow Club, where we produce one-pagers. A one-pager is basically a summary on a one page of what we just went through. In fact, I just went through one page behind me, an Excel version, but this is the printed version out, where we'll give you 10 years of data on a whole host of companies, a return estimate, and let you look at the assumptions and figure out for yourself, is this interesting? You want to take the model that you would have had and change it? You're able to do that. My name is Cameron Stewart, CFA. This is Rational Investing. Thank you for watching the channel, the comments, and subscribers. I greatly appreciate it. Hit that subscribe button if you are a fan of the channel. It always helps me out. All right, have a great day. Bye-bye.